Okay, let's just take a breath. It is Tuesday, February 24, 2026. And if you've opened your portfolio apps this morning, you're probably seeing a lot of red.
Yeah, a very specific, painful shade of red.
Exactly. Bitcoin has punched right through support, testing that $60,000 range. And the mood is tense.
It is heavy. But this is exactly why we do these deep dives into the source material. Because if you are just staring at the charts or, doom scrolling, you're missing the structural shift happening underneath it all.
Right, the disconnect. Because on the surface, a price drop looks like a disaster. But our research stack for this deep dive shows a totally different reality. We have massive institutional news firing off at the exact same moment the price is dropping.
Which feels wrong. The old playbook was always, institutions enter, the number goes up.
But that's not what's happening. So
Yeah.
we have a provisional conclusion for you to start this analysis. This drop to 60,000, it is not a contradiction of institutional adoption.
No, not at all.
It is a recalibration of what we're defining as an exo-institutional insurance premium.
That is the exact phrase to keep in mind today. Exo-institutional insurance premium.
And to see why that premium is recalculating, we need to look at three simultaneous signals. First, a major Bitcoin holding company, BSTR, preparing for a public listing. Second, Russia legalizing the seizure of crypto assets. And third, a sharp price correction hitting right alongside the U.S. administration's new 15% tariff announcement.
It's a velocity mismatch.
A velocity mismatch, right, between the capital flows and the policy architecture.
Exactly. We are looking at this through the lens of institutional convergence, multiplying by price recalculation. Capital moves fast. You can sell an ETF in a second. But passing a law, listing a SPAC, that takes months.
So the price drop is just the friction between those two speeds.
Yes. And as a reminder to you listening, this channel functions as a structural reading log. The more we observe these events, the clearer the float becomes. We want no abstraction drift today. No delayed thesis.
Let's get right into it then. We have a structured roadmap for the first half of our discussion. We're going to look at this through three layers: narrative positioning, incentive alignment, and structural price function.
Which brings us to section 1, the narrative layer.
Re-anchoring our thesis here, we are looking at how stories drive short-term volatility versus how structures drive long-term price. And right now, we have a dual narrative playing out.
It's a totally split screen. On one side, you have institutional recognition. This is the BSTR news.
BSTR, the Bitcoin Standard Treasury Company.
Right. Led by Adam Back, holding 30,000 Bitcoin and preparing to list on the NASDAQ via a merger with Cantor Equity Partners the First.
Which is a massive signal.
It's huge. It's the ultimate narrative of acceptance. The Bitcoin Standard becoming literal corporate policy. But then, on the other side of the screen,
you have institutional control.
Yes, Russia. President Putin just signed a law defining crypto as intangible property.
Specifically to allow state seizure and confiscation during criminal investigations.
Exactly. It is not a ban. It is the state exerting sovereignty over the asset. So you have ETF access expanding on one hand and state-level enforcement tightening on the other.
Which creates a ton of noise. And in the short term, that noise looks like volatility.
It does. It's like the AI disruption narrative a while back when legacy tech stocks dropped on AI fears and Bitcoin just followed suit, acting like a risk asset.
Right, acting like tech instead of a safe haven. And then you throw the tariff chaos into the mix.
The flat 15% U.S. tariff, that policy chaos just scrambles the market's ability to price things in.
So that's the narrative layer. Moving to section 2, the incentive layer. Let's re-anchor our thesis again. We need to move from what is happening to why these actors are moving. We have to look at the incentive split.
And we have to look at incentives, not morality. Corporations like the STR or Treasury Strategy, who just bought another $40 million worth, their incentive is capital access.
They want to blend into the legacy system.
Right. They want to leverage their holdings. States, however, seek sovereign control. Russia doesn't want to destroy the asset. They just want to ensure they can seize it.
So corporations want access, states want control. What about investors?
Investors seek optionality. If you look at the options market right now, there is a surge in put options with strike prices down to $40,000.
Meaning they are buying the route to sell at $40,000 just in case of a crash.
Yeah, they are buying insurance. But simultaneously, they are holding call options at $75,000.
They don't want to miss the upside.
Exactly. Which leads us to a key definition for this deep dive. Bitcoin's price right now is not the value of a currency.
It is the price of optional exit from institutional systems.
Let me say that again because it's vital. The price of optional exit. And in the medium term, this reshapes capital allocation behavior.
Which we are seeing with the ETF outflows, right?
Yeah.
Almost $4 billion in outflows in 5 weeks.
Institutional capital fleeing risk in the medium term. But the long-term holders on-chain are still accumulating. Again, it's that velocity mismatch. Selling the ETF is fast, building the corporate treasury is slow.
So we've covered narratives and incentives. Let's move to Section 3, the structural OS layer. And re-anchoring our thesis, we need to contrast Bitcoin against the traditional systems insurance, which is gold.
This insurance distinction is where things get really clear. Gold is intra-institutional insurance. Bitcoin is exo-institutional insurance.
Explain the difference for us.
Sure. So XW1 research shows gold and Bitcoin have broken their correlation. They are negatively correlated right now. Gold is rising because central banks are buying it. It is insurance inside the traditional system.
Gold strengthens when institutions consolidate internally.
Exactly. But Bitcoin strengthens when trust dispersion increases, when you need insurance outside the system.
But wait, if we have tariffs and seizures and all this geopolitical tension, shouldn't trust dispersion be high right now? Shouldn't Bitcoin be going up?
You would think so, but we have to look at the time contrast. In the short term, liquidity dominates. The U.S. economic data, like the PPI and jobless claims, is forcing the Fed to keep rates high.
Sucking liquidity out of the room.
Right. So the market is treating Bitcoin as a risk asset right now. It is a liquidity squeeze. Financial flows are dominating the short term.
But the medium term brings incentive shifts.
And the long-term structural slope depends entirely on whether the world fragments further, which is bullish for exo insurance, or reintegrates, which favors inter-insurance like gold.
So we are looking at a gradient, not making a prediction.
Absolutely.
That brings us to the deep structural layer, because this price correction does not negate the institutional convergence we talked about.
No, it just reflects the recalculation of the risk premium under tightening liquidity.
So framing the horizons explicitly, short term is liquidity compression. Medium term is incentive realignment. Long term is institutional fragmentation versus reintegration.
That's the gradient. And it's highly plausible without making any apocalyptic predictions.
Right. Which takes us to Section 4, the structural inertia layer. This is critical. There is obvious structural pressure right now.
Immense pressure.
Yet there is no visible systemic rupture.
We are in an absorption phase, not an inflection point.
Let's talk about how the market is absorbing this. Because the price broke 65,000, it's testing 60.
That is delayed price pass-through. It is the market physically absorbing the lack of liquidity. And you also have regulatory normalization acting as an absorber.
Like the Russian law and the U.S. ETF ecosystem.
Right. The system is normalizing the asset. It's regulated, it's taxable, it's seizable. It's not a political pariah anymore. Corporations are internalizing the volatility.
But we should be clear, stability is not equilibrium.
No, not at all.
Yeah.
Just because we are finding a floor doesn't mean the tension is gone. The MVRV ratio, the market value to realized value, is at 1.6.
Which means we aren't at a cyclical bottom yet.
The pressure is still there. We're just in the absorption phase.
And people are nervous. I mean, look at the rise of tools like Material CC.
Yeah, the AI tool designed to monitor social network panic and predict crashes by watching liquidity dry up.
The fact that a tool like that even exists proves how hypersensitive the market is to this structural inertia. They are waiting for the dam to break.
But again, no escalation here. We're just observing the current state.
Which perfectly transitions us into Section 5, our ECP-9 extension.
Right. ECP-8, which we've been discussing, describes our current position, integration versus recalibration. But ECP-9 asks about the future multiplier.
The recalculation of that multiplier.
Yes. If Bitcoin is exo-institutional insurance, its price intrinsically embeds expectations about future institutional stress.
So what are the key variables for that multiplier?
Well, sovereign trust stability is a big one. If the U.S. flat tariff causes a massive trade war, trust goes down.
Geopolitical fragmentation.
Exactly, and capital mobility constraints. But you also have to factor in the liquidity regime. If the Fed keeps rates high to fight sticky inflation, liquidity stays tight.
So the recalculation we're seeing, this price drop, it is not a prediction of collapse.
No, it is simply the present valuation of future optionality. The market is basically asking, how much is the exit door worth if I can't afford the ticket today?
That's exactly it. They are lowering the premium they are willing to pay for future optionality because liquidity is so expensive right now.
It's just math.
All right, let's compress this structure as we wrap up. We looked at the narrative layer, contrasting BSTR's corporate adoption with Russia's state control.
We examined the incentive layer, with ETF outflows fighting the optionality of the options market.
And we broke down the structural OS, showing how gold and Bitcoin have decoupled as intra versus exo-institutional insurance.
That is the structure.
So the directional gradient here, the current slope, suggests recalibration rather than rupture. The asset is being repriced due to tight liquidity, but the structural adoption continues unabated.
It does.
Which leaves you, the listener, with a final forward-looking question to consider. If liquidity tightens while geopolitical fragmentation persists, does the multiplier embedded in that premium expand or remain contained?
Does the premium compress as institutions stabilize or expand as the world fragments?
It's the ultimate question. So, to leave you with our mandatory takeaway for this deep dive, Bitcoin's price currently reflects a recalculating exo-institutional insurance premium within an absorption phase of global structural stress.
Keep your eye on the structural slope.
Thanks for joining us for this deep dive.